If you enjoyed this podcast, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the book. Chapter 1. Seeds of Wealth, The Magic of Growing Money. Part 1. The First Gold Coin, Why Saving Matters. When Benjamin Franklin scribbled "A penny saved is a penny earned" in his almanac, he captured a truth that would transform millions of lives. Yet most people struggle with this fundamental principle, watching their paychecks disappear into an endless stream of purchases while their bank accounts remain stubbornly empty. Warren Buffett bought his first stock at age 11 with $104.75 he had saved from delivering newspapers and selling golf balls. That single decision to save rather than spend launched one of history's greatest fortunes. His story illustrates a simple reality. Every dollar you save today becomes a soldier fighting for your financial future. Think of saving like planting an apple tree. You could eat the seed immediately and satisfy a momentary hunger, or plant it and eventually harvest bushels of apples for decades. Most people choose the immediate satisfaction, then wonder why they never build wealth. The ancient Babylonians understood this principle 4,000 years ago, consistently setting aside 1/10 of their earnings regardless of income level. Modern research supports this ancient wisdom. A 2019 Federal Reserve study found that 40% of Americans couldn't cover a $400 emergency expense without borrowing money. Meanwhile, those who saved just $25 weekly from age 25 accumulated over $65,000 by retirement through compound growth alone. The difference between these groups isn't income level, it's saving discipline. Your brain fights against saving through what psychologists call present bias. The pleasure of buying something today feels more real than the abstract benefit of future wealth. Dave Ramsey discovered this when he went bankrupt despite earning substantial income as a real estate developer. His mistake wasn't poor investment choices. It was failing to maintain adequate savings while pursuing aggressive growth strategies. The psychological benefits of saving extend beyond financial security. Studies show that people with emergency funds report lower stress levels and better sleep quality. They make career decisions based on passion rather than desperation. They negotiate from positions of strength rather than financial vulnerability. Consider your savings account as insurance against life's inevitable surprises. When your car breaks down or unexpected medical bills arrive, saved money transforms potential disasters into minor inconveniences. Without savings, these events force you into debt, creating negative compound interest that works against you. Starting feels overwhelming when you're living paycheck to paycheck, but the goal isn't perfection, it's progress. Vicki Robin, author of Your Money or Your Life, began her financial journey saving loose change in a jar. That humble beginning eventually funded early retirement and decades of financial freedom. The key lies in treating savings like a non-negotiable expense. Pay yourself first, even if it's only $5 weekly. Automate the process so willpower doesn't become a factor. Create separate accounts for different goals to make progress visible and emotionally satisfying. Your first saved dollar might seem insignificant, but it represents something profound. The moment you decided your future mattered more than today's temporary desires. Part 2. Small streams grow big. The wonder of compound interest. When Albert Einstein allegedly called compound interest the eighth wonder of the world, he captured something that transforms ordinary savers into millionaires. Yet most people fundamentally misunderstand how this financial force operates, missing opportunities that could reshape their entire economic future. The difference between simple and compound interest resembles the contrast between a puddle and a river. Simple interest pays you the same amount each year, like earning $50 annually on a $1,000 deposit at 5%. Compound interest, however, pays interest on your interest, creating exponential growth that accelerates over time. Consider Warren Buffett's first stock purchase at age 11. He bought 3 shares of Citi Service preferred stock for $38 each. While that $140 investment seems modest, Buffett understood something profound about compounding that most adults miss. His net worth now exceeds $100 billion, largely because he started early and let compound interest work across decades. The mathematics proves startling. A 25-year-old who saves $2,000 annually until age 35, then stops completely, will accumulate more wealth by retirement than someone who starts at 35 and saves $2,000 every year until age 65. The early starter contributes just $20,000 total, while the late starter contributes $60,000. Yet at 7% annual returns, the early starter ends with approximately $565,000 compared to the late starter's $490,000. Morgan Housel documents in The Psychology of Money how this counterintuitive reality confounds people. We instinctively think linearly, expecting equal inputs to produce equal outputs. Compounding operates exponentially, where small differences in time or return rates create massive outcome variations. The key lies in understanding that compound interest rewards patience over everything else. George S. Clason illustrated this principle in The Richest Man in Babylon through Arcad's transformation from poor scribe to wealthy citizen. Arcad saved 1/10 of his earnings consistently, but his true wealth came from letting those savings compound through wise investments over many years. Modern savers can harness this same power through basic investment accounts. A $100 monthly contribution earning 8% annually becomes $349,000 after 30 years. The contributions total just $36,000, but compounding generates the additional $313,000. This isn't magic. It's mathematics working relentlessly in your favor. The challenge involves overcoming our psychological biases. Humans prefer immediate gratification over delayed rewards, even when the delayed rewards prove dramatically larger. Dave Ramsey emphasizes in The Total Money Makeover that building wealth requires embracing this discomfort, making compound interest your employee rather than your enemy. Starting today matters more than starting perfectly. Every month you delay reduces your final wealth substantially. The river of compound interest flows strongest for those who jump in earliest, regardless of the initial splash size. Part 3. Time is your friend. How waiting builds fortunes. When Warren Buffett's father gave him his first shares of stock at age 11, few imagined this gift would eventually create one of history's greatest fortunes. The secret wasn't superior intelligence or perfect timing. It was the extraordinary power of starting early and letting decades work their magic. Research from Fidelity reveals that investors who began saving in their 20s accumulated nearly twice the wealth of those who started just 10 years later, despite contributing similar amounts. Think of time as a financial amplifier that grows stronger with each passing year. When George Clason wrote about the wealthy men of Babylon, he illustrated this principle through Arcad, who saved 1/10 of his earnings for decades. The first years felt painfully slow, but by year 20, his money was working harder than he was. This mirrors what Edward Chancellor documents in Financial History. The most successful savers understood that time transforms modest discipline into extraordinary wealth. Consider two friends who graduated college together in 1990. Sarah invested $2,000 annually for just 10 years, then stopped completely. Her friend Mike waited until age 35 to begin, then invested $2,000 every year until retirement. Despite Mike contributing twice as much money, Sarah's early start gave her portfolio a 30-year head start that compounding could exploit. When they both retired, Sarah's $20,000 investment had grown to over $800,000, while Mike's $60,000 reached only $540,000. The mathematics behind this outcome reveals why Sidney Homer called compound interest the most powerful force in finance. Each year, your money remains invested. It doesn't just earn returns, it earns returns on all previous returns. This creates an exponential curve that starts slowly but accelerates dramatically in later years. Morgan Housel notes that Buffett accumulated 99% of his wealth after age 50, not because he suddenly became a better investor, but because time had sufficient years to compound his earlier gains. Yet our psychology works against this principle. Vicki Robin observes that humans struggle with delayed gratification, preferring immediate spending over future wealth. The smartphone in your pocket cost $800 that could have grown to $25,000 over 30 years. This isn't about living like a monk. It's about recognizing that money has different values at different life stages. The opportunity cost of delayed action proves staggering. Dave Ramsey's research shows that someone beginning retirement savings at 25 needs to save just $95 monthly to reach $1 million by 65. Wait until 35, and that figure jumps to $286 monthly. Wait until 45, and you'll need $971 monthly, 10 times more effort for the same result. Time doesn't just multiply your money, it reduces your financial stress. Early savers sleep better knowing their wealth grows automatically, while late starters face increasing pressure to save larger percentages of their income. The river of compound growth flows most powerfully for those who jump in youngest, turning patience into your most valuable financial skill. Part 4. The Piggy Bank's Secret. Interest in Everyday Life. When Sarah's 8-year-old daughter Emma asked why her piggy bank money grew after sitting untouched for months, Sarah realized something profound. Interest rates aren't abstract financial concepts confined to banks and investment firms. They're woven into the fabric of our daily lives, quietly shaping decisions we make dozens of times each week without conscious awareness. Emma's piggy bank actually contained more than the coins she'd deposited because her grandmother had promised to add 10 cents for every dollar Emma saved each month. This simple arrangement perfectly mirrors how formal interest works, yet it felt natural and unthreatening to a child. The same principle applies when you delay gratification on any purchase, effectively earning interest through avoided costs or better deals found through patience. Consider the Miller family's approach to their teenager's car loan. Rather than borrowing from a bank at 8% interest, they created an internal family loan at 4%. Their son pays the family back monthly, learning responsibility while the family earns returns higher than their savings account offers. This arrangement saves the family hundreds in interest payments while teaching valuable lessons about borrowing costs. Interest rates surface in unexpected places throughout our daily routines. When grocery stores offer buy now, pay later options with no stated interest, they're often building those costs into inflated prices. When you pay bills early to receive discounts, you're essentially earning interest on money you already owe. When you choose between paying cash or financing a purchase, you're making an interest rate calculation whether you realize it or not. Dave Ramsey's research with thousands of families reveals that people who consciously recognize these hidden interest decisions typically save 15 to 20% more annually than those who don't. The difference isn't intelligence or income, it's awareness of how interest quietly influences spending patterns. The most powerful everyday application involves credit card timing. Sarah learned to pay her monthly expenses on a rewards credit card, then immediately transfer money to a high-yield savings account. By paying the full balance before interest charges apply, she earns rewards on necessary purchases, while her payment money earns interest for up to 30 days. This simple strategy generates an extra $300 to $400 annually from money she was spending anyway. Even small lending decisions between friends involve interest considerations. When you loan someone $50 until payday, you're forgoing whatever return that money might have earned elsewhere. Understanding this opportunity cost helps you make smarter decisions about informal lending and borrowing. The key insight Emma's grandmother understood is that making interest tangible through concrete examples removes intimidation and builds intuitive understanding. Once you recognize how interest rates influence everything from bill payment timing to informal family loans, you start seeing money management opportunities everywhere. These small, conscious choices compound over time, turning everyday financial decisions into wealth-building habits that require no dramatic lifestyle changes. Chapter 2. Borrowed Dreams: Understanding Loans Without Fear. Part 1. The Price of Now. Why People Borrow. When Rihanna needed $3 million to launch Fenty Beauty in 2017, she didn't wait until she saved every penny. She borrowed against future earnings and turned that debt into a billion-dollar empire. This decision reveals something profound about human nature. We consistently choose today over tomorrow, even when tomorrow might be mathematically better. Sarah, a 28-year-old teacher in Denver, recently took out a $45,000 student loan to complete her master's degree. She could have waited 5 years to save the money, but her salary would have remained stagnant during that time. The loan allowed her to immediately earn $15,000 more annually, making the debt a profitable investment. Her story illustrates why borrowing isn't inherently bad. It's about timing and opportunity cost. Stanford psychologist Walter Mischel's famous marshmallow experiment from the 1960s demonstrated that most children prefer one treat now over two treats in 15 minutes. Adults exhibit similar patterns with money. We'll pay premium prices through loans rather than delay purchases, even when we understand the mathematical cost. This preference for immediate gratification drives the entire lending industry. Consider Jeff Bezos in 1994. He convinced his parents to invest $245,000 in a risky online bookstore called Amazon. When that wasn't enough, he sought additional financing from banks and investors. Without borrowed capital, Amazon might have remained a small operation competing with established bookstores. Bezos understood that timing often matters more than cost when pursuing opportunities. Housing markets demonstrate this principle clearly. In 1970, the median home price in California was $24,000. Today, that same house costs $750,000. Families who borrowed money in 1970 to buy homes built wealth through leverage, while those who saved to buy with cash missed decades of appreciation. The mortgage interest they paid proved insignificant compared to the gains from owning property during inflationary periods. Education represents another compelling case for strategic borrowing. Warren Buffett borrowed money to attend Columbia Business School, where he studied under Benjamin Graham. That $10,000 investment in education generated billions in returns throughout his career. Similarly, medical students routinely borrow $200,000 to $400,000 for their education, understanding that their future earning potential justifies the debt burden. However, borrowing for consumption tells a different story. Credit card debt for vacations, dining, or luxury goods creates no future income stream to offset interest costs. The average American carries $6,200 in credit card debt, paying 18% annual interest on purchases that lose value immediately. The key distinction lies in productive versus consumptive debt. Productive debt generates future income or appreciates in value. Mortgages, business loans, and education financing often fall into this category. Consumptive debt pays for goods or experiences that provide no financial return. Smart borrowers also understand that cheap money won't remain cheap forever. During the 2010s, mortgage rates dropped below 3%, creating an unprecedented opportunity. Families who refinanced or purchased homes during this period locked in historically low borrowing costs for 30 years. When used strategically, debt becomes a tool for building wealth rather than a burden that constrains it. Part 2. The true cost: unpacking loan interest. When Netflix borrowed $15 billion in 2015 to fund original content, their interest costs consumed nearly $400 million annually. This staggering figure illustrates a fundamental truth. Interest represents the actual price of borrowing money, often transforming what seems affordable into a financial burden that extends decades beyond the initial purchase. Think of interest as rent for money. Just as you pay to occupy someone else's apartment, you pay lenders for temporarily using their capital. This payment compensates them for two crucial factors: the risk you might not repay and the opportunity cost of lending to you instead of investing elsewhere. When banks offered mortgage rates near 3% in 2012, they were essentially saying the combination of risk and alternative investment returns justified that price. The annual percentage rate, APR, provides the most accurate picture of borrowing costs because it includes both interest and fees. A credit card advertising 18% interest might carry a 22% APR once annual fees and penalties are factored in. This difference matters enormously over time. Consider two $20,000 car loans. One at 4% APR for 5 years costs $368 monthly and totals $22,094. The same loan at 8% APR costs $406 monthly and totals $24,331. That 4 percentage point difference costs an extra $237. Compounding amplifies these effects dramatically. Unlike simple interest calculated only on the principal, compound interest charges interest on accumulated interest. Credit card debt exemplifies this destructive force. A $5,000 balance at 18% APR, making only minimum payments, takes over 30 years to pay off and costs more than $11,000 in interest. Payday loans demonstrate extreme compounding, with APRs often exceeding 400%. A typical 2-week $300 payday loan costs $45 in fees, but rolling it over just 4 times creates $480 in total costs. Even small rate differences compound dramatically over longer periods. A $300,000 30-year mortgage at 4% costs $250,610 in interest. The same loan at 5% costs $279,767 in interest, $64,157 more. This explains why mortgage shoppers save thousands by comparing rates from multiple lenders, even when differences seem minimal. Understanding interest calculations empowers better decision-making. Before accepting any loan, calculate the total cost using online calculators or the formula: monthly payment, number of payments, principal, total interest cost. This simple step reveals whether the convenience of borrowing justifies the expense. Smart borrowers also recognize that interest rates fluctuate with economic conditions. The Federal Reserve's rate decisions directly influence borrowing costs. During the 2008 financial crisis, rates dropped to historic lows, creating opportunities for refinancing and strategic borrowing. Conversely, rising rates in 2022 pushed mortgage costs above 7%, pricing many buyers out of housing markets. The key lies in viewing interest not as an abstract concept, but as a concrete cost that either accelerates or derails financial goals. Part 3. Beware the trap, common loan pitfalls. Jamie Martinez thought she was getting a great deal on her $15,000 car loan at 4.9% interest. 6 months later, she discovered her monthly payment included a $300 credit insurance fee she never requested, pushing her effective interest rate to nearly 12%. Her story illustrates how borrowers often focus solely on advertised rates while missing the costly details that transform seemingly affordable loans into financial quicksand. The most dangerous loan traps hide in plain sight. Payday lenders advertise $15 for every $100 borrowed, which sounds reasonable until you realize this translates to an annual percentage rate exceeding 400%. A 2-week $300 payday loan costs $345 to repay, but most borrowers can't pay it back immediately and end up rolling it over multiple times. The Consumer Financial Protection Bureau found that 80% of payday borrowers renew their loans within 2 weeks, creating a cycle where fees accumulate faster than principal payments. Credit cards present equally deceptive scenarios through minimum payment structures. Consider Sarah's $5,000 credit card balance at 18% interest. Making only minimum payments of $100 monthly, she'll pay for 94 months and spend $4,311 in interest alone. The card company profits from this extended repayment because compound interest works relentlessly against borrowers who carry balances. Mortgage loans contain their own hidden dangers. Adjustable rate mortgages might start at attractive teaser rates like 3%, but when rates reset after 2 years, payments can jump dramatically. During the 2008 housing crisis, millions of homeowners discovered their payments had doubled when promotional periods ended, leading to widespread foreclosures. Auto dealerships masterfully disguise loan costs through payment manipulation. They'll ask, "What monthly payment works for you?" instead of discussing total loan cost. A customer agreeing to $400 monthly payments might unknowingly sign a 7-year loan instead of a 4-year one, paying thousands extra in interest for the same vehicle. Personal loans from online lenders often carry origination fees ranging from 1% to 8% of the loan amount. A $10,000 loan with a 6% origination fee means you receive only $9,400, but must repay the full $10,000 plus interest. These fees effectively increase your true interest rate beyond the advertised figure. Smart borrowing requires asking specific questions. What's the total amount you'll repay over the loan's life? Are there prepayment penalties if you pay early? What happens if you miss a payment? Calculate the true cost using this formula. Total payments, principal equals total interest and fees. Always request loan documents in writing before signing, and never let salespeople pressure you into immediate decisions. The most effective defense against loan traps involves shopping around and understanding that the lowest advertised rate rarely tells the complete story. Compare total costs, not just monthly payments. And remember that if a loan offer seems too good to be true, it probably contains expensive surprises waiting to surface later. Part 4. Winning the Game. Paying off debt without tears. When Michelle sat across from her credit counselor in 2019 with $47,000 in debt spread across 8 credit cards, she felt suffocated by monthly minimums that barely touched her principal balances. 2 years later, she had eliminated every penny of debt and discovered something profound. The right repayment strategy transforms an overwhelming burden into a manageable game with clear rules and achievable victories. The debt snowball method, championed by financial educator Dave Ramsey, prioritizes paying minimums on all debts while attacking the smallest balance first, regardless of interest rate. When Dave worked with over 10,000 families through his counseling practice, he noticed something counterintuitive. People who paid off their smallest debts first, even when mathematically suboptimal, maintained motivation and completed their debt elimination journey more frequently than those who focused purely on numbers. Consider Sarah, a teacher from Ohio who owed $2,800 on a store card, $8,500 on a car loan, and $18,000 in student loans. Using the snowball approach, she tackled the store card first. Within 4 months, that victory provided psychological fuel to attack the car loan with intensity. The emotional momentum from crossing debts off her list proved more powerful than the mathematical advantage of targeting higher interest rates first. The debt avalanche method takes the opposite approach, targeting the highest interest rate debt while maintaining minimums elsewhere. This strategy saves money over time, but requires stronger mental discipline. James, an engineer from Seattle, calculated that his 24.99% credit card debt cost him $208 monthly in interest alone. By focusing his extra payments there first, he saved $3,400 over 18 months compared to the snowball method. His analytical personality thrived on watching interest expenses shrink each month. Which method suits your personality? If you need quick wins to stay motivated, choose the snowball. If you can maintain discipline while watching numbers slowly improve, the avalanche saves more money. Both work when executed consistently. Creating a realistic budget forms the foundation of any successful debt repayment plan. Start by tracking every expense for 30 days using your bank statements. Most people discover they spend $200 to $400 monthly on forgotten subscriptions, impulse purchases, and convenience items. Redirecting these funds toward debt creates substantial payment power without dramatic lifestyle changes. Negotiating with lenders often produces surprising results. When COVID-19 hit, major credit card companies approved hardship programs for millions of customers, reducing interest rates and payment amounts. Call your lenders directly and explain your situation honestly. Many prefer modified payment plans over default losses. The psychological aspect of debt repayment matters more than most financial advice acknowledges. Each payment represents reclaiming control over your financial future. Michelle discovered that watching her debt balances decrease each month provided more satisfaction than any purchase had in years. The freedom from debt stress improved her sleep, relationships, and work performance in ways she never anticipated. Maintaining motivation requires celebrating milestones along the journey. When you eliminate each debt, acknowledge the achievement. The path from debt to financial confidence builds character and money management skills that serve you throughout life. Chapter 3. Stories from the Market. When Rates Change Everything. Part 1. The Seesaw, How Rates Rise and Fall. In March 2020, something extraordinary happened in financial markets worldwide. Within 3 weeks, the Federal Reserve slashed interest rates from 1.75% to nearly zero, and central banks across the globe followed suit. The speed of these cuts revealed something most people never see. Interest rates behave exactly like a playground seesaw, constantly moving up and down based on the weight of economic forces pressing on each side. Think of this seesaw with economic growth and inflation on one end, and unemployment and financial stability on the other. When Jerome Powell and the Federal Reserve Board meet 8 times per year, they're essentially deciding which end needs more weight. During the 2008 financial crisis, they pushed rates down to nearly zero for 7 years. When unemployment dropped to historic lows in 2018, they gradually raised rates to prevent the economy from overheating. The seesaw metaphor becomes crystal clear when you examine Paul Volcker's dramatic actions in the early 1980s. Facing inflation rates above 14%, he pushed interest rates to an unprecedented 20%. The economic pain was severe. Unemployment soared to 10.8%, but inflation was crushed. Volcker deliberately shifted the seesaw's weight, accepting short-term economic suffering to achieve long-term stability. Central banks don't operate in isolation. They respond to supply and demand forces in money markets. When banks have excess reserves, they lend more freely, naturally pushing rates down. When credit becomes scarce, rates rise automatically. The Fed's role is to amplify or counteract these natural movements through policy decisions. Consider how quickly the seesaw moved during COVID-19. Within weeks, mortgage rates plummeted from 3.7% to historic lows of 2.65%. Savers who had enjoyed higher returns suddenly watched their certificates of deposit renewal rates drop by more than half. The speed shocked many Americans who assumed rate changes happened gradually. But what triggers these movements? Employment data releases every first Friday of the month can shift rate expectations dramatically. When unemployment dropped unexpectedly in June 2023, bond markets immediately priced in higher future rates. Inflation reports create similar volatility. A single consumer price index reading above expectations can push mortgage rates up within hours. The seesaw also responds to global events. When the European Central Bank raises rates, it affects the balance here. During the 2011 European debt crisis, investors flooded into U.S. Treasury bonds, pushing our rates down despite domestic economic strength. Money flows globally, seeking the best risk-adjusted returns. Understanding this seesaw helps explain why timing major financial decisions around rate movements often backfires. In 1994, Alan Greenspan began raising rates, and many investors expected a steady climb. Instead, rates zigzagged unpredictably for months. The lesson remains relevant today. The seesaw's movements are more complex than they appear, influenced by forces both seen and unseen, making prediction far more challenging than most realize. Part 2. The Ripple Effect. Rates and your savings. When Federal Reserve Chairman Jerome Powell announced a 0.75 percentage point rate hike in June 2022, Sarah Chen watched her high-yield savings account jump from 0.5% to 2.1% within weeks. What seemed like financial good fortune, however, told only half the story. Inflation was running at 9.1%, meaning her money was still losing purchasing power despite earning more interest. This scenario perfectly illustrates how interest rate changes create ripples through your personal finances in ways that aren't always immediately obvious. When rates rise, savers celebrate higher returns on certificates of deposit and money market accounts. Bank of America customers saw their savings rates climb from near zero in early 2022 to over 4% by late 2023. Yet the real question becomes whether these gains actually improve your financial position. Consider the mathematics behind this relationship. In 1981, when Paul Volcker pushed interest rates to historic highs, some savings accounts offered 15% returns. Sounds incredible until you realize inflation peaked at 14.8% that same year. Savers earned impressive nominal returns, but barely broke even in real terms. The lesson remains relevant today. Higher rates don't automatically translate to increased wealth. The timing of rate changes creates additional complexity for savers. When the Federal Reserve cut rates to near zero during the 2008 financial crisis, retirees who had relied on bond income and CD returns faced a harsh reality. Many had to drastically reduce their standard of living or take on more investment risk than they were comfortable with. Dorothy Martinez, a retired teacher from Phoenix, saw her annual income from a $500,000 CD portfolio drop from $25,000 to less than $2,500 between 2007 and 2010. Smart savers learned to position themselves ahead of rate movements rather than simply reacting. During the 2004 to 2006 rate hiking cycle, those who locked in longer-term CDs at progressively higher rates benefited significantly. When rates eventually fell during the financial crisis, they continued earning 4 to 5%, while new savers struggled with near-zero returns. The ripple effects extend beyond simple savings accounts. Rising rates make existing bonds more attractive relative to new issues with lower yields. Conversely, when rates fall, those holding higher-yielding bonds see their market value increase. This relationship explains why legendary investor Warren Buffett increased Berkshire Hathaway's Treasury bill holdings to over $150 billion when rates reached multi-decade highs in 2023. Understanding these ripples requires monitoring more than just the Federal Reserve's benchmark rate. Banks often lag in passing rate increases to savers while quickly raising loan rates. During the 2022-2023 tightening cycle, average savings account rates remained below 1%, even as the Fed funds rate reached 5.25%. Online banks and credit unions typically offer better rates than traditional banks, but even they adjust with delays. The key insight for savers is recognizing that rate changes create both opportunities and challenges simultaneously. Higher rates benefit new savings but can signal economic uncertainty ahead. Lower rates might hurt current income, but often accompany policies designed to stimulate growth. Successful savers focus on real returns after inflation rather than nominal rates, diversify across different savings vehicles, and maintain the flexibility to adapt as conditions change. Part 3. Chasing the best. Finding good deals. When Warren Buffett made headlines in 2008 by purchasing $5 billion worth of Goldman Sachs preferred shares during the financial crisis, he wasn't just making a bold investment move. He was demonstrating a principle that smart money follows. When rates shift dramatically, the best opportunities often hide in plain sight, waiting for those who know how to look beyond the market panic. The challenge most people face when interest rates move isn't recognizing that change is happening. It's knowing how to respond without making costly mistakes. Consider what happened in 2022 when the Federal Reserve began its aggressive rate hiking cycle. Many homeowners rushed to refinance their mortgages, fearing they'd miss their last chance at low rates. Others waited, convinced rates would drop again soon. Both groups made decisions based on fear rather than strategy. The mortgage market provides perhaps the clearest example of how rate movements create distinct winners and losers. In early 2020, mortgage rates hit historic lows near 2.5%. Smart borrowers who secured these rates before the 2022 surge now hold what amounts to financial gold. Meanwhile, those who delayed faced rates climbing past 7% by late 2023. The difference between these rates means roughly $1,000 more per month on a $400,000 mortgage. But the real lesson isn't about timing the market perfectly. It's about understanding the relationship between different financial products when rates change. When mortgage rates rise, banks often boost savings account rates with a delay. This creates windows of opportunity. Marcus by Goldman Sachs, for instance, raised their savings rates from 0.5% in early 2022 to over 4% by late 2023, while many traditional banks barely moved above 1%. The key lies in comparing not just rates, but the complete package. During rate transitions, lenders often adjust fees, terms, and requirements alongside advertised rates. Credit unions frequently offer better deals than big banks during these periods because they operate with different profit motives. Navy Federal Credit Union consistently offered mortgage rates 0.5% below major banks throughout 2023's volatile period. Fixed versus variable rate decisions become crucial during these transitions. When rates are rising, locking in fixed rates protects against further increases. When rates are falling or expected to fall, variable rates can capture the downward trend. The challenge is reading the signals correctly. Economic indicators like employment data, inflation trends, and Federal Reserve communications provide clues, but they require interpretation. Smart shoppers develop what behavioral economists call decision frameworks rather than relying on gut feelings. They establish criteria beforehand: maximum acceptable rates, minimum required terms, and clear exit strategies. This preparation prevents rushed decisions when attractive offers appear or when fear dominates headlines. The most successful approach involves monitoring multiple markets simultaneously. When mortgage rates spike, car loan rates often follow, but personal loan rates might lag. Credit card promotional rates frequently move independently. Understanding these patterns helps identify where the best opportunities exist at any given moment. Remember, every rate environment creates both challenges and opportunities. The goal isn't perfection, but rather positioning yourself to benefit from change rather than becoming its victim. Part 4. The world reacts. What happens when everyone pays attention? When Warren Buffett saw interest rates plummet to near zero in 2008, he didn't panic buy everything in sight. Instead, he watched as entire industries made decisions based on crowd behavior rather than fundamentals. The legendary investor understood something most people miss. When everyone reacts to rate changes simultaneously, the collective response often creates more volatility than the original rate move itself. Consider what happened during the 2020 pandemic when the Federal Reserve slashed rates to historic lows. Banks didn't just quietly adjust their lending policies. They launched massive marketing campaigns promising cheap money. Real estate agents flooded social media with "buy now before rates rise" messages. Investment firms pushed low-yield bond funds to desperate savers. The result wasn't gradual adjustment, but a frenzied rush that sent housing prices soaring 20% in many markets within 12 months. This collective behavior amplifies every rate movement through 3 predictable waves. First comes the institutional response. Banks immediately adjust their prime rates, mortgage companies revise their offerings, and insurance companies recalculate their investment returns. These changes happen within days, sometimes hours, of Federal Reserve announcements. The second wave involves businesses and investors. When rates dropped in 2020, companies rushed to refinance debt, issue new bonds, and acquire competitors with cheap borrowed money. Tesla issued $5 billion in new shares, partly because borrowing costs made expansion irresistible. Private equity firms went on buying sprees knowing they could finance deals at historically low costs. The third wave brings individual consumers into the mix. This is where rational decision-making often breaks down. People see their neighbors refinancing mortgages and assume they should too, regardless of their specific situation. They hear about stock market gains funded by cheap credit and feel pressure to invest money they can't afford to lose. The fear of missing out becomes stronger than careful financial planning. Japan's experience in the 1980s illustrates how collective behavior can create dangerous bubbles. When rates fell, everyone from banks to individuals poured money into real estate and stocks. Land prices in Tokyo became so inflated that the Imperial Palace grounds were theoretically worth more than all of California. When reality set in, the subsequent crash created economic stagnation lasting decades. The antidote to herd mentality requires conscious effort. Morgan Housel observes in The Psychology of Money that successful long-term investors often ignore short-term rate movements entirely. They focus on their personal financial goals rather than what everyone else is doing. They ask themselves, does this rate change actually affect my 10-year plan? Smart money managers use collective overreactions as opportunities. When everyone rushes toward the same investments because of rate changes, they often create mispricings in overlooked areas. While crowds chase hot real estate markets during low-rate periods, patient investors might find better values in dividend-paying stocks or international markets that haven't yet caught the crowd's attention. The key is maintaining perspective when financial headlines scream about rate changes. Yes, these shifts matter for your personal finances, but the crowd's reaction to rate changes often matters more than the changes themselves. Stay focused on your individual circumstances rather than joining every financial stampede that comes along. Chapter 4. The Money Masters. How Big Players Set the Rules. Part 1. The Invisible Hand. Meet the Central Bank. When Ben Bernanke faced the 2008 financial crisis as Federal Reserve Chairman, he made a decision that would affect every American's mortgage, credit card, and savings account. He cut interest rates to nearly zero overnight. Within weeks, homeowners saw refinancing opportunities explode while savers watched their CD returns vanish. This single institution's choice rippled through 300 million financial lives instantly. Think of the central bank as the thermostat in your house, but instead of controlling temperature, It adjusts the cost of money itself. When Jerome Powell and the Federal Open Market Committee meet 8 times yearly in that marble building in Washington, they're essentially setting the price every bank charges for loans and pays for deposits. Their decisions flow through Chase, Wells Fargo, and your local credit union like water through connected pipes. The Federal Reserve operates with deliberate independence from political pressure. Congress designed it this way after witnessing how political interference destroyed currencies in other nations. When politicians control money printing and interest rates, they tend to choose short-term popularity over long-term stability. Germany's Weimar Republic printed money to fund government spending, creating hyperinflation that required wheelbarrows of cash to buy bread. America's founders learned from such disasters. Today's Fed governors serve 14-year terms specifically to outlast multiple presidential administrations. This structure allows them to make unpopular but necessary decisions. In 1979, Paul Volcker raised interest rates to 20% to crush inflation, triggering a recession, but saving the dollar's purchasing power. Politicians condemned him, but history vindicated his courage. The central bank pursues what economists call a dual mandate: maximum employment and stable prices. These goals often conflict. Lowering rates stimulates job creation, but can trigger inflation. Raising rates controls price increases, but may cause unemployment. It's like driving a car where the accelerator and brake are connected to different wheels. Consider how this played out during the pandemic. The Fed slashed rates to zero and purchased trillions in bonds to prevent economic collapse. Unemployment fell dramatically, but inflation surged to 9% by 2022. Powell then reversed course, raising rates aggressively to cool prices, risking recession but protecting the dollar's value. Every Fed decision creates winners and losers instantly. When rates drop, borrowers celebrate lower mortgage payments, while retirees see income from savings accounts disappear. When rates rise, savers earn more, but homebuyers face higher costs. The central bank doesn't pick favorites. It attempts to balance these competing interests for overall economic health. Understanding this institution matters because its choices directly affect your financial future. Whether you're planning a home purchase, managing debt, or saving for retirement, the central bank's policy direction shapes your options and outcomes more than any other single factor in the economy. Part 2. Why they move the needle. Making sense of rate decisions. When Federal Reserve Chair Jerome Powell steps to the podium, millions of Americans hold their breath without realizing it. His words about interest rates will determine whether that dream home becomes affordable or slips away, whether retirement savings grow or stagnate. Behind every rate decision lies a complex juggling act involving 3 powerful economic forces that central bankers monitor like vital signs. Picture inflation as an overexcited party guest who keeps turning up the music. When prices rise too quickly, the Fed raises rates to cool things down, making borrowing more expensive and encouraging people to save rather than spend. In 1979, Fed Chair Paul Volcker faced inflation running at 13.5%. He cranked rates to 20%, triggering a recession, but ultimately taming price growth. Homebuyers suffered as mortgage rates soared, but the economy emerged healthier. Today's Fed learned from Volcker's playbook, raising rates from near zero to over 5% between 2022 and 2023 to combat post-pandemic inflation. Employment represents the second vital sign. Central bankers want people working, but not so frantically that wages spiral upward and fuel inflation. The Fed targets maximum employment alongside price stability, creating a constant balancing act. When unemployment hit 14.8% during the 2020 pandemic, the Fed slashed rates to zero to encourage business borrowing and hiring. Companies could access cheap capital to maintain payrolls, while individuals faced lower borrowing costs for everything from car loans to credit cards. Economic growth completes this 3-legged stool. Too much growth creates bubbles and instability. Too little brings recession and unemployment. Fed officials study GDP reports like doctors examining patient charts. During the 2008 financial crisis, growth contracted sharply, prompting emergency rate cuts to 0.25%. Banks could borrow cheaply from the Fed and theoretically pass those savings to consumers through lower loan rates. The art lies in timing these moves correctly. Raise rates too early and you choke off recovery. Wait too long and inflation becomes entrenched. Alan Greenspan earned the nickname the Maestro for his perceived ability to fine-tune this balance during the 1990s economic expansion. However, critics later argued his low rates contributed to the housing bubble that burst in 2008. What makes this balancing act fascinating is how quickly circumstances change. In March 2020, the Fed cut rates dramatically as COVID-19 emerged. By 2022, they were raising rates aggressively as inflation surged. Each decision creates immediate winners and losers. When rates rise, existing bondholders see their investments gain value, but new borrowers face higher costs. When rates fall, refinancing becomes attractive, but savers earn less on deposits. Understanding this decision-making process helps explain why your mortgage rate changes or why your savings account yield fluctuates. Central bankers aren't targeting you personally. They're trying to maintain economic equilibrium. These rate moves filter through the entire financial system, affecting everything from corporate expansion plans to individual retirement strategies. Part 3. Keeping calm. How to adapt when the tide changes. When Janet Yellen raised interest rates 7 times between 2015 and 2018, millions of Americans suddenly faced a new financial reality. Credit card rates climbed, mortgage payments increased, but savings accounts finally offered meaningful returns. Those who panicked sold investments at losses, while others who stayed calm repositioned their finances strategically and came out ahead. The key difference wasn't luck or timing. It was preparation and perspective. Rate changes aren't personal attacks on your budget. They're economic adjustments that create both challenges and opportunities. The question isn't whether rates will change, but how ready you'll be when they do. Start with your debt. When rates rise, your variable rate credit cards and adjustable mortgages become more expensive. Toyota's finance division saw customers refinance auto loans en masse during the 2020 rate drops, saving thousands in interest payments. But when rates climbed again in 2022, those same customers were insulated because they'd locked in lower fixed rates. The lesson? Act quickly when favorable rate environments emerge, but don't panic when they shift against you. Consider Sarah Chen, a teacher from Portland who restructured her entire debt strategy during the 2016 rate increases. Instead of making minimum payments on multiple credit cards, she consolidated everything into a fixed-rate personal loan before rates climbed higher. While her friends complained about rising costs, Sarah's payments remained stable, and she paid off her debt 2 years earlier than planned. Your savings strategy needs similar flexibility. When JP Morgan Chase raised savings rates from 0.1% to 4.3% between 2022 and 2023, customers who had parked money in checking accounts missed out on thousands in potential earnings. Smart savers moved funds into high-yield accounts and short-term certificates of deposit, capturing higher returns without sacrificing liquidity. But here's where many people stumble. They treat every rate change like a crisis requiring immediate action. Warren Buffett famously kept buying stocks during the 1970s inflation crisis when rates soared above 15%. His long-term perspective meant short-term rate volatility became buying opportunities rather than reasons to flee. Build your rate change playbook before you need it. Know which debts are variable versus fixed. Understand how your mortgage, car loan, and credit cards respond to rate shifts. Research high-yield savings options so you can move quickly when opportunities arise. Most importantly, maintain an emergency fund that covers 6 months of expenses. This buffer lets you make strategic decisions rather than desperate ones. The most successful people don't predict rate changes. They prepare for them. They view rising rates as chances to earn more on savings and falling rates as opportunities to refinance debt. This mindset transforms monetary policy shifts from threats into tools for building wealth. Remember, central banks change rates to maintain economic stability, not to disrupt your personal finances. When you align your strategy with these broader economic cycles rather than fighting them, you position yourself to benefit regardless of which direction rates move next. Part 4. Your next step: building a future with smart money moves. When Maria started her career as a software engineer in 2015, she made 3 decisions that transformed her financial trajectory. She automated her savings before she could spend them, she learned to read economic signals like a weather forecast, and she treated every rate change as market intelligence rather than market noise. By 2023, while her colleagues worried about mortgage rates and inflation, Maria had built a portfolio worth six figures and owned her home outright. The difference wasn't luck or a higher salary. Maria understood something that George Clason wrote about nearly a century ago in The Richest Man in Babylon. Wealth grows when you make your money work as hard as you do. She started with the fundamental principle of paying herself first, automatically transferring 15% of each paycheck into high-yield accounts before any other expenses. This wasn't revolutionary advice, but her execution was methodical. Maria also educated herself about the economic environment around her. She subscribed to Federal Reserve meeting minutes, not because she enjoyed dense financial prose, but because she recognized these decisions directly affected her mortgage rate, her savings account yields, and her investment returns. When the Fed signaled rate increases in 2022, she locked in a certificate of deposit at 4.5% while others hesitated. When they hinted at future cuts, she refinanced her mortgage at historically low rates. The key insight from Edward Chancellor's research on interest rate history proved invaluable. Rates move in long cycles, not random jumps. Maria learned to think in decades, not quarters. She structured her debts to benefit from falling rates and her savings to capitalize on rising ones. During the 2020 pandemic, while many people panicked about market volatility, she increased her stock purchases because she understood that temporary disruptions create permanent opportunities for patient investors. Her approach mirrors the philosophy Dave Ramsey advocates, but with a crucial addition. She actively monitored the interest rate environment. Maria treated the Federal Reserve's dual mandate of price stability and full employment as her personal economic compass. When unemployment fell and inflation rose, she prepared for higher rates. When economic growth slowed, she positioned herself for lower rates. The psychological component proved equally important. Morgan Housel's research on money behavior helped Maria recognize that her biggest enemy wasn't market volatility, but her own impulses. She created systems that removed emotion from financial decisions. Her investment contributions automated regardless of market conditions. Her emergency fund sat in boring, high-yield savings accounts that she never touched. Today, Maria reviews her financial position quarterly, adjusting her strategy based on economic indicators rather than headlines. She continues learning about monetary policy, tax strategies, and investment vehicles because she views financial education as career development. The time she invested in understanding how central banks operate and how interest rates affect different asset classes has paid compound returns far beyond any single investment. Your financial future depends on similar strategic thinking. Start by automating your savings, then educate yourself about the economic forces shaping interest rates. The central bank isn't your adversary. It's providing valuable market information if you know how to interpret the signals. Chapter 5. Tales of the Everyday Investor. Real Stories. Wise Choices. Part 1. From Pennies to Pounds. How Real People Grew Their Savings. When Ronald Read died in 2014, the small Vermont town of Brattleboro was stunned to learn that the quiet janitor and gas station attendant had accumulated $8 million. Red, whose highest salary never exceeded $20,000 annually, exemplified how ordinary people can achieve extraordinary financial results through patience and compound interest, proving that starting with pennies really can lead to pounds. Read's story isn't unique in its fundamentals, though the numbers might surprise you. Like many everyday millionaires studied by researchers at Emory University, he understood something profound about money that escapes most people. Time matters more than timing. While his neighbors debated which stocks to pick, Read systematically invested small amounts in blue-chip companies and never sold. His portfolio grew through decades of dividend reinvestment and compound returns. Consider Ann Scheiber, another unlikely millionaire who retired from the IRS in 1944 with $5,000 in savings. Through careful stock selection and unwavering discipline, she transformed that modest sum into $22 million by her death in 1995. Scheiber's approach was remarkably simple. She bought shares in companies whose products she used daily, Coca-Cola, PepsiCo, and Schering Plough, then held them for decades while reinvesting every dividend. The mathematics behind these transformations reveal compound interest's true power. Warren Buffett, perhaps history's most famous compound interest beneficiary, accumulated 99.7% of his wealth after age 50. His early investments, made with paper route money and modest savings, had decades to multiply. This pattern appears repeatedly among self-made millionaires. Early starts with small amounts, consistent additions, and extraordinary patience. Dave Ramsey's research on everyday millionaires supports this pattern. The typical millionaire in his study invested consistently for 28 years, with many starting their wealth-building journey earning less than $100,000 annually. They didn't inherit fortunes or win lotteries. They simply understood that regular contributions to retirement accounts and investment portfolios, combined with time, create financial security. What made these individuals different wasn't their income levels or investment sophistication. Theodore Johnson, a UPS employee who never earned more than $14,000 annually, became a $70 million philanthropist by investing 20% of his income consistently. His secret wasn't complex. He treated savings like a non-negotiable expense, similar to rent or utilities. The compound effect extends beyond stock investments. Consider how consistently paying extra principal on a mortgage can save hundreds of thousands in interest over time. A homeowner paying an additional $100 monthly on a $300,000 mortgage at 4% interest saves approximately $65,000 and shortens the loan by 7 years. These stories share common elements: modest beginnings, consistent habits, and respect for time's role in wealth building. They prove that financial success isn't about earning enormous salaries or making brilliant investment decisions. It's about starting early, staying consistent, and letting compound interest work its mathematical magic over decades. Part 2. Escaping the Debt Trap: Lessons Worth Sharing. Sarah Martinez stared at her credit card statement in 2018, watching numbers that seemed to mock her every financial decision. The balance read $47,000 across multiple cards, with minimum payments consuming nearly half her monthly income as a teacher in Phoenix. Yet today, she owns her home outright and maintains a 6-figure emergency fund. Her transformation began with one painful realization: she had been fighting symptoms instead of addressing the disease itself. Like many Americans drowning in debt, Sarah initially tried balance transfers and consolidation loans, moves that felt productive but merely shuffled the problem around. The breakthrough came when she calculated her true cost of borrowing. Her average interest rate of 22% meant that without aggressive action, she would pay over $180,000 for her original $47,000 debt over minimum payment periods. This mathematical reality hit harder than any financial advisor's warning. Sarah's story mirrors research from the Federal Reserve Bank of Boston, which found that successful debt elimination requires addressing behavioral patterns, not just payment strategies. She implemented what debt counselors call the visibility principle, writing every purchase on paper before buying anything. This simple act reduced her impulse spending by 67% within 3 months, a figure that aligns with MIT studies on payment transparency. The avalanche method became her weapon of choice. While conventional wisdom often suggests paying minimum amounts on all debts except the smallest, Sarah focused extra payments on her highest interest obligations first. This approach saved her approximately $23,000 in interest compared to the popular snowball method, according to her detailed records. Her second crucial decision involved seeking help without shame. Sarah joined a debt support group where she met Tom Rodriguez, a former construction worker who had eliminated $89,000 in debt following a business failure. Tom's advice proved transformative. Treat debt elimination like a part-time job. He worked delivery shifts 3 evenings weekly, applying every dollar earned directly to his highest interest debts. The psychological component proved as important as the mathematical one. Sarah's group practiced what behavioral economists call implementation intentions, specific if-then scenarios for handling spending temptations. When faced with a $200 impulse purchase, she would automatically calculate how many months of minimum payments that amount represented. This mental framework converted abstract debt balances into concrete time commitments. Sarah's final debt payment came 34 months after her initial awakening. The interest savings from her accelerated approach allowed her to transition immediately into aggressive saving, building her emergency fund in just 18 additional months. Her story demonstrates that debt elimination isn't merely about mathematical optimization. It requires confronting the behaviors that created the problem initially. Today, Sarah counsels other teachers facing similar challenges. Her most powerful advice centers on measurement. Track everything, calculate true costs, and remember that temporary sacrifice creates permanent freedom. The compound effect that once worked against her through accumulating interest now works in her favor through accelerating savings. Part 3. Dancing with Rates, What I Learned from Market Ups and Downs. When James Martinez refinanced his home in 2021, he thought he'd mastered the system. With rates at historic lows near 2.8%, he pulled cash out for renovations and felt brilliant. 2 years later, watching rates climb past 7%, he discovered what financial veterans know. The market doesn't care about your timing. It teaches you about resilience instead. The emotional weight of rate fluctuations hits hardest when you're actually living through them. Patricia Chen, a nurse from Portland, watched her savings account yields plummet from 2.5% to 0.1% during the 2020 rate cuts. Her initial frustration gave way to creativity as she researched online banks offering better returns. This search led her to discover treasury bills and certificates of deposit, diversifying her approach beyond traditional savings. What felt like a setback became financial education she never expected to receive. Rate cycles create winners and losers, often simultaneously within the same household. The Kowalski family experienced this firsthand during the 2008 crisis. Their adjustable rate mortgage payment jumped from $1,800 to $2,400 monthly, straining their budgets severely. Meanwhile, their savings finally earned meaningful interest for the first time in years. This contradiction forced them to think differently about debt structure and emergency funds. The psychological challenge of rate volatility often surprises people more than the financial impact. Michael Thompson, a small business owner, secured a business loan at 5% in early 2022. Within 18 months, similar loans cost 9%. Rather than dwelling on missed timing, he focused on accelerating payments to reduce principal faster. His experience illustrates how rate changes force strategic thinking beyond simple cost calculations. Experienced investors like Rebecca Walsh treat rate fluctuations as information rather than obstacles. During rising rate periods, she increases her cash holdings, knowing better yields await. When rates fall, she locks in longer-term investments or refinances debt. This approach requires patience but removes much emotional stress from rate watching. The most valuable lesson from rate volatility involves adaptation over prediction. Carlos Mendez learned this managing his retirement portfolio through multiple rate cycles. Instead of trying to time perfect entry points, he developed consistent strategies, maintained diverse income sources, avoid over-leveraging, and remember that all cycles eventually reverse. His portfolio weathered 2008, 2020, and recent rate increases because his approach expected change rather than fighting it. What separates successful rate navigators from frustrated observers is their relationship with uncertainty. They view rate changes as market conditions requiring response, not personal attacks requiring defense. This mindset shift transforms financial stress into strategic opportunity, making each cycle a chance to refine rather than merely survive their approach to money management. Part 4. Your Story Begins. A Personal Plan for Smarter Money. When Sarah Martinez opened her laptop on a Sunday evening in March 2024, she faced a financial crossroads that millions recognize: scattered accounts, mounting monthly payments, and a nagging sense that her money could work harder. 3 hours later, she had created something that would transform her relationship with every dollar. A personal financial story with herself as the protagonist. Your financial story begins the moment you decide to write it deliberately. Unlike the tales of compound interest wizards or debt escape artists, your narrative starts with honest assessment and simple action. Sarah's story illustrates this perfectly. She listed every account, every debt, and every monthly expense on a single spreadsheet. No apps, no complicated software, just clarity about where money flowed in and out of her life. The most successful personal financial plans share three characteristics. They reflect individual circumstances, they anticipate change, and they prioritize progress over perfection. Consider how different people approach the same challenge. When interest rates climbed in 2022, Maria Gonzalez shifted her emergency fund from a checking account yielding 0.1% to a high-yield savings account paying 4.5%. Her neighbor kept his money in the same checking account for convenience. Both choices reflected their personalities, but only one aligned with changing market conditions. Setting financial objectives requires honest conversation with your future self. What does financial security look like in your specific situation? For James Chen, a freelance graphic designer, security meant maintaining 12 months of expenses in savings due to irregular income. For teacher Amanda Walsh, it meant maximizing her employer's retirement match while aggressively paying down student loans. Neither approach was universally correct, but both addressed their unique circumstances. Choosing saving strategies becomes intuitive when you understand how interest works for you. High-yield savings accounts serve different purposes than certificates of deposit, which serve different purposes than money market accounts. The key lies in matching products to timelines. Emergency funds need immediate access, making high-yield savings accounts logical choices. Money earmarked for a house down payment in 3 years might benefit from CDs or treasury bonds, depending on current rates. Loan strategies follow similar logic but work in reverse. Every extra payment toward a 6% student loan effectively earns you 6% guaranteed return. When Jennifer Adams faced choosing between extra mortgage payments and additional retirement contributions, she calculated the math. Her 3.2% mortgage rate versus expected investment returns made retirement contributions the better choice. Your calculation might differ based on your rates and risk tolerance. Staying informed about interest rates requires developing simple habits rather than becoming an economics expert. Sarah checks the Federal Reserve's website monthly, not daily. She subscribes to one financial newsletter that explains rate changes in plain English. Most importantly, she reviews her accounts quarterly to ensure her money moves with market opportunities. Your financial story writes itself through consistent small actions rather than dramatic gestures. Start with one change this week. Open that high-yield savings account. Make one extra debt payment. Calculate how much interest you paid last month. Small chapters accumulate into compelling narratives, and your story of financial wisdom begins with the first sentence you choose to write.